To me, NVIDIA is driven purely by the earnings at the moment. And obviously, there's hype around AI. People want to be in on the AI story, but it seems to me like almost every single earnings, they continue to deliver on earnings, massively over-deliver on earnings. And as we know, the part of the reason why NVIDIA is doing so well is because these other mega tech companies are spending billions of dollars on NVIDIA chips. The thing that has probably moved gold the most this year is just demand, and that's buying of gold from central banks. What they have in common is they're central banks from countries that are exporting countries. I think the main swing factor though this year has to be about the Chinese retail consumer. China's property market has been going through a major crisis. And so people have lost confidence in the real estate market and have resorted to buying gold in order to protect their wealth.
Hello and welcome to the Achieving Alpha podcast. My name is Stephen and I am the host of the show. Today I'm delighted to be joined by Will Rhind, who is the CEO of GraniteShares ETFs. GraniteShares provide low-cost and innovative ETFs to the consumer in both the tech space as well as in precious metals. Welcome to the show. Really great to have you on.
Thank you, Steve. Great to be on the show.
So how's everything with you in New York today?
Yeah, pretty good. Pretty good. I see that obviously we're about to start the day here and market's down, but after the Tesla earnings. But apart from that, I can't complain too much.
All right. Really looking forward to talking to you today about all things that are happening in the market. But as it's your first time on the show, I wanted to get a little bit more about your background and your career in finance.
Yeah, no, absolutely. So by background, I'm from the UK originally, just like you, but from a bit further north. I'm from Aberdeen on the northeast coast of Scotland, and I was working or have been working in London in finance for a number of years. My first job out of university was an investment bank called Nomura. And then afterwards, I moved into the asset management space and joined a company that was known at the time as Barclays Global Investors, which now everyone would know as BlackRock. And that was because BlackRock acquired Barclays Global Investors in the financial crisis of 2008. And so that's significant because BlackRock, or BGI at the time, we were doing the first ETFs in Europe, and of course under the iShares brand, which people might know today in terms of ETFs. We were really at the forefront of creating the ETF industry that everybody knows today. So back when I was there in the early 2000s, there was only one company doing it, and that was us. And now you have hundreds of companies around the world that do ETFs for a living. So I started there and really have followed the ETF product throughout my career. So I joined a startup after BlackRock called ETF Securities, and that was a startup that was doing the first commodity-based ETFs, again in London and in Europe. That became very successful, was sold ultimately to WisdomTree, which is another big ETF company. And then afterwards, I was the CEO of the largest gold ETF in the world called GLD. So CEO there for 2.5 years, and that was a joint venture between State Street and the World Gold Council. And then left there and started my own business, GraniteShares, in 2016. So we went live 2017 and have been growing the company ever since. But kind of in that time, I moved to New York 14 years ago. Ended up going there with ETF Securities at the time and set up their business in the US. Ended up staying here in New York. And so 14 years later, it's home for me. And GraniteShares, we are a global ETF company. So we issue ETFs here in the US, also in European markets as well. And we are accessible really all around the world. So all you need is a brokerage app and access to either the US or the European markets to buy our products.
Okay. All right. It seems like you're going from strength to strength and adding more ETFs regularly year by year. I wanted to ask you, how do you go about choosing which ETFs that you offer to your clients? And what is the main role that your clients are using the ETFs in their portfolios?
That's a great question. So it really, think of what we do as like a design or an architecture firm in some respects, whereby first and foremost, it's a product first business. So we have to create the ideas of tomorrow or the investment strategies of tomorrow, which we believe investors want. And a combination, sometimes that is directly based on investor feedback. So the leveraged single stocks, which we'll talk about, are clearly an area where people will come to us all the time and request certain stocks. And that's an easy one to think about. The harder one is when we're coming up with an investment strategy that doesn't exist today. And again, from an investor perspective, it's not necessarily the case they'll think about that. And it's our job to think about what might make sense in the current interest rate environment, in the current macro environment, and we launch an ETF based upon that. So typically, that means that if we're tracking an index, we'll solicit index providers to come up with that particular strategy. Or if it's an active strategy, then obviously we do that ourselves. But ultimately, like I said, we're trying to provide the ideas of tomorrow. What will be the investment themes? What resonates with people? And it's our job to design those products, to bring them to life, and to have people invest in them.
Okay. And I understand that you do lots of different levered ETFs in individual stocks, mainly those of either the Magnificent Seven or some of the larger tech stocks in the US. What's the idea behind having these levered single stocks in people's portfolio, and how are the majority of your investors using these? Are they using them to hold longer term, or are they more a short term kind of trading or hedging asset?
Yeah, so it's an interesting story. We had experience with levered products in a previous company. However, those were levered products on commodities. And leveraged ETFs, just more broadly, have been around for a long time, 10, 15 years minimum now, and really span the gamut of broad equity indices, broad fixed income indices, commodity indices. And funnily enough, no one had ever really thought to do that on individual stocks. And so, really, one of the main ideas for starting GraniteShares was to be the first company to create leveraged ETFs on single stocks. And I suppose the idea was simple, which is that we knew there was demand for other leveraged strategies, leveraged commodities, leveraged equity indices, and we thought clearly that there'd be demand for single stocks. But more than that, we thought it was probably a more intuitive application. In other words, when people did lever using margin accounts, traditional brokerage accounts, take out margin loan to go long on a particular security, it was more likely that they were doing that on individual stocks rather than broad indices. So we thought that it was a more intuitive application. And effectively, we pioneered this new ETF structure. And so there was a new category that didn't exist before. We started doing it in Europe. And the reason why is because at the time we couldn't do it in the US. And so we started doing it in Europe in 2019. And we have a huge selection on all major European markets of long and short. Typically, we're 3 times levered in Europe, so 3 times long, 3 times short. And we cover things like UK stocks, obviously US tech stocks. If it's in Italy, it'll be Italian stocks and US tech stocks. And so we see clearly that started to take off. And then it was really when we bought that, the regulations changed and we were able to bring those to the US. And we've just seen this like monumental growth from those particular products. And I guess coming back to your question, the reason why it's popular is because there's really 2 things happening that we can talk about. Of course, tech stocks are popular, but what are we fundamentally doing? We're disrupting the traditional margin account and we're providing institutionally priced leverage to the masses. And that is at the core of the proposition. Then, obviously, how do we do that? Of course, we're providing 2x leverage on NVIDIA and Tesla, etc. But fundamentally, that's what's changed is it's better access to margin, better access to leverage, and better price. And of course, that's a winning proposition in most sort of markets when people think about it.
Yes, that makes a lot of sense to be able to provide the consumers with options, right? So they've got the options of going in with leverage long if they need to. But I also noticed that you do inverse single stocks as well, which gives them another kind of vehicle to be able to maneuver the markets. How popular are those inverse ETFs?
It really depends on the stock and the timing. So it's a really interesting investor psychology exercise in that, first and foremost, as we know, the majority of investors can't go short, even professional investors. Professional investors, the vast majority of professional money managers do not and cannot go short. So it's a big sort of exercise that's missing in the industry largely, and really it's only hedge fund managers and a select number of professional traders that do that. So the skill of going short is actually something that is really scarce in the industry. And I think that is in part the reason why we're skewed long to the market just naturally. So naturally, the amount of shorts in the market are always a small percentage relative to the amount of longs. And that's really reflected, I think, in the asset base that we have. So in other words, the vast majority of our AUM sits in long, 2x long products. And we have a not insignificant amount, but it's way smaller than the longs in the shorts. And those shorts are going to be dominated by certain companies like NVIDIA and Tesla. And it's a combination of people using those for outright directional profits if they think the stock strategically is going to go down, for example, over a period of time. Or it's what a lot of people do is for hedging. So in purpose or parts around earnings where they think, okay, maybe this could have a bit of an air pocket here in earnings. I'll take the short because I don't want to liquidate my long position and realize a taxable gain or a taxable event. So there are a number of different ways to use it, but overwhelmingly, the vast majority of people are long. And I think that just reflects what we see in the market more broadly.
Yes. Yes, and that's a good segue as well to what's happening in the broader markets. Obviously, it's been a very good year so far, especially for tech stocks this year and also last year as well, after quite a hard 2022. What we've seen is this year, we've seen tech stocks really rally, but they seem to have been dominated by those Magnificent Seven, or what is now being referred to as the Magnificent Six, because Tesla hasn't quite kept up with the other ones. What's your views on the overall market and the fact that the Magnificent Seven are pulling away from the other tech stocks in the markets?
Yeah, I think just on the market more broadly, and principally I'm going to be talking about the US market, when I talk about the market, is look, we've had a good year, like you said. I think fundamentally that's going to continue. I really feel like now the momentum is behind the market in terms of interest rates, inflation expectations. Almost certainly now the last few kind of inflation prints we've had have been positive, meaning coming down. And that almost certainly means we're going to get rate cuts before the end of the year, which clearly the market likes, the economy likes more broadly. So I think the macro picture is really quite positive. But let's be clear, right? After everything was repriced in a new interest rate environment. And so companies have really had to deliver on earnings to generate the kind of performance that they've delivered over the last couple of years. And so what you've seen is the strongest companies have broken out, and those have been the largest tech companies because they are the most powerful companies in terms of any real metric that you look at, but certainly profitability, free cash flow, balance sheet, etc. And so those companies have really led the pack and have outperformed on earnings. And as you briefly mentioned, the only one really, with the exception of Apple in a couple of quarters, that didn't outperform or hasn't outperformed is Tesla. And again, disappointing earnings again last night. Not exactly unexpected if you follow the stock and you know what's going on with, again, the EV sector. But overall, we're talking about a very positive story for the market. I think what sort of goes hand in hand with that is the fact that small caps have also started to rally over the last week or so. And that to me shows again a sign of strength that the rally is potentially broadening out into the wider market, and these companies that previously were not benefiting because of the interest rate environment, because I think 30% something crazy like that of the Russell 2000 are actually not profitable companies. And so clearly they're badly affected by high interest rates and debt burdens. And so if those start to readjust, then you see more positive price performance in Russell or the small caps. Again, we go back to the Magnificent Seven, and the Magnificent Seven is the kind of acronym, is the moniker for this time. But I think it's really just a continuation of the same story that we've now seen for a long time, and that was before COVID, before 2022. We referred to these companies as FANG stocks. And the reason why, again, we had this acronym for FANG was that these were the companies that were driving all the performance in the S&P 500, in the NASDAQ. And so we, again, came up with an acronym for them at the time to say, hey, these are the companies that are really driving the market. And 2022 affected all stocks, but I would say now, or I would argue now, that we're just reverting back to the trend that was already in place beforehand, which is these companies are going to dominate and continue to dominate for some time, while these tech trends are very much tailwinds for them, whether we're talking about the cloud, whether we're talking about AI, whether we're talking about search, whether we're talking about energy. They're all tailwinds for these companies. And when you take a step back and you think about companies like NVIDIA being worth more than the entire UK stock market, or being worth more than the entire German stock market, and obviously it's not just NVIDIA, it's the largest tech companies, it's Apple, it's Microsoft. It really makes you think that this is something special, that this is unique, it's happening here in the United States, and to be worth more than the country's entire stock market means that these are companies that are something special. There is, simply, there is no NVIDIA in the UK, or there's no NVIDIA in Europe. There's no Apple in Europe. It's only happening in the US, and I think that's reflected in the performance.
And do you think some of that is also caused by the passive inflows into these companies through the NASDAQ and the S&P 500?
Oh, absolutely. Absolutely. The way that the world works today is that you have vast amounts of flows into the major indices. And so S&P 500, NASDAQ, et cetera, et cetera. So when you have a company that goes into the S&P 500 or goes into the NASDAQ, automatically that company is going to get a lot of flows. And clearly that was one. Tesla was probably the last big Magnificent Seven stock to do that. So when they entered the S&P 500, it added that extra sort of spurt of growth because all the index funds, all the pension funds, et cetera, had to buy. Again, that's why when you look at the market is dominated by these companies because they make up on any given day 20-25% whatever of the S&P 500, of the NASDAQ. And when those companies are performing well, the market's up. If they're not, the market's down.
Yeah. Yeah. And do you think there's a real fear of a concentration risk in those major indexes? Because as you said, over 25% of them are from those Magnificent Seven companies. Do you think that there's a real risk of, if there was a big recession or anything happened to those tech companies and their earnings were to suffer quite significantly, that it could really affect the markets?
Yeah, I think certainly concentration will be an issue or is an issue for some. And there are a number of ways to get around that. I'd say the vast majority of people, or at least the people that we talk to, and I put myself in this camp, that I think that the concentration is a healthy thing because you want to be betting on companies that are the best companies. I think the cream always rises to the top in terms of these large companies. And so when you're invested in a broad index, it goes hand in hand that you're getting most exposure to the most valuable, largest companies. And so I think if that's an issue for people, like I said, in ETF world or ETF land, there's plenty of ways you can get around that. You can buy equally weighted strategies for one particular thing, or you can clearly just focus on buying small caps. But ultimately, I don't think you can really ignore the phenomenon that's going on here. And again, providing these tech trends remain in place, there's no reason to believe that these companies won't continue to be dominant over the next few years.
Okay. And if we look at NVIDIA in particular, it's had a storming performance this year. And actually, it's really had a storming decade, really. if we look at some of the mega trends that are going on at the moment, such as AI, artificial intelligence, NVIDIA has been a big recipient of that mega trend. Do you think that potentially there could be some type of bubble ahead for NVIDIA and other AI companies, or do you think that the valuations are warranted considering the amount of revenue and profits that they're bringing in?
To me, NVIDIA is driven purely by the earnings at the moment. And obviously, there's hype around AI. Of course, there is. People are excited about it. People want to be in on the AI story. But it seems to me like almost every single earnings we've had over the last, let's say 4 quarters, that we've had the bears come out saying it's the top, NVIDIA is due to correct, can't possibly keep up this pace, but yet they continue to deliver on earnings and massively over deliver on earnings. So I think for there to be a bubble in NVIDIA, clearly there has to be something fundamentally that changes with the AI thesis. And as we know, the part of the reason why NVIDIA is doing so well is because these other mega tech companies are spending billions of dollars on NVIDIA chips. And so this is real capex that we can see coming from the other massive cloud companies, effectively, but the hyperscalers, as they're called, that are spending this money, and that is going to NVIDIA. So we'll see, obviously, with the next earnings coming up. But to me, the only way we'll be able to say if AI is a bubble or not is clearly if something fundamentally changes. And I think it's way too early to say that in terms of how AI will really fundamentally affect our lives. I can tell you for sure, as a business owner, pretty much every company I know, I can't think of a good example of somebody who's not using AI, but everybody is trying to use AI in some way, shape, or form. And that might be something very simple, maybe a bit of marketing automation, or something a lot more complex in terms of coding, etc. However, everybody's trying to use it. And again, I'm not really seeing anybody that's telling me, hey, you know what? This AI stuff's a load of nonsense. We're not interested in using it. I don't hear that at all.
Yeah, I think everybody's trying to drive as much efficiency as they can. And I think as AI develops, it's going to get more and more useful, and it's going to get more and more intelligent. And that should therefore drive the efficiencies much more as time progresses. Is there any kind of signals that you might look for where you think NVIDIA might start to stall? Is there any kind of technical signals or anything from the product that you'd be looking at where you say, okay, this might have run its course?
I mean, we can point to technicals, whether you look at the 50-day moving average or 200-day moving average, things like that. The problem with that has been that every time that there's been the hint of NVIDIA stalling out, it seems to be able to either grind higher or surge higher on the back of the latest sort of story that is positive for the stock. So it's just a runaway train at the moment. And the only thing I can see that slows it down is I don't think it'll even be the earnings results themselves. It would have to be some kind of guidance that they issue to guide down expectations that, hey, we see demand slowing down here. And we'll have to wait and see if that comes out.
Is there any competitors for NVIDIA that you're also looking at?
Yeah, the whole space, really. So Taiwan Semiconductor, AMD, and really across the AI space, I wouldn't say that they're competitors to NVIDIA really in any way, but the whole AI space is interesting. People are looking at companies like Dell has had a massive resurgence. So anybody that's really a beneficiary of this, whether you're in the hardware space, providing chips, etc., whether you're providing software, it's really just something that I think has caught the imagination of investors at the moment. And I'd say the 2 biggest themes this year so far have been AI and crypto, although crypto's maybe come off the boil a little bit the last month or so. But those, to me, have been the standout themes of this year so far.
It just shows that it's gone into a risk-on environment.
Yeah, that's right.
And if we look at the kind of a wider market, obviously we had a lot of inflation after COVID. And then after COVID, when business started ramping up again and demand started ramping up, we had a lot of inflation. which caused the Fed to increase their rates pretty significantly. So earlier on in the conversation, you mentioned that you're expecting the interest rates to come down. How aggressively do you think that they will decrease those interest rates towards the end of 2024 and into 2025?
I think that they will remain data dependent, to use their phrase. So very much will be guided by the CPI data, inflation data. I don't think it will be aggressive because I think they'll want to maintain, again, some modesty around doing that because the economy is so strong. I don't think there's a sort of a massive reason to pull back on interest rates in any significant way, unless you start to see some more kind of bad news or some potential credit crisis emerging from the real estate sector or the regional banks, something like that. But I think so far those crises have been contained, and if we start to get a reduction in interest rates, even just one cut, which was the expectation, I think, before the last sort of batch of inflation data perhaps showed that there was more room to go, and maybe we might now be talking about 2 cuts or more. But I think even with 1 cut, the point is it's signaling that the Fed is ready to start cutting rates, and that's really what the market is looking for more than anything else.
Yeah. And they've given it a significant amount of time to make sure that inflation doesn't have any of these kind of sticky, large spikes up in the market again. I think probably the more gradual that they're actually reduced, the probably better it is for the market, because if they're reduced very quickly, it's a sign that something's broken inside of the market, right?
Yeah. That's right. Again, that was always the sort of the counter argument that you had to think about why would a central bank lower rates? And traditionally, we weren't talking about this particular environment. The reason why they would lower rates is because the economy was entering into recession. And so by lowering rates, it was actually a bad thing because they were trying to fight off the effects of inflation. And therefore, almost certainly, you'd be talking about recessionary environment where the stocks and everything else would be down. This time around, it's a unique, again, situation where we're talking about potentially lowering rates because inflation allows you to do that, to maybe make the economy run, or certain sectors of the economy run more smoothly. And I think certainly we have a problem in real estate that's just obvious to everybody. And so unlocking that is certainly something that would be a natural byproduct of lowering rates, along with clearly some of the loans that are out on commercial real estate that are held by regional banks, etc. That's definitely a problem that could escalate quite quickly if rates are held too high for too long.
And you probably noticed that being in New York, right? The people leaving the offices and starting to work from home and stuff after COVID probably had a real effect on the commercial real estate market and the rents.
Oh, absolutely. It's life-changing in terms of how this has happened, and this idea that now in New York, and a lot of companies will be back to the office at least a few days a week. But I think it's now clearly nothing to do with COVID. It's just a sort of a lifestyle change or a change in the work environment, that the catalyst was COVID, but the lasting effects will be more of this idea that work is going to be more flexible. And so that has had a devastating effect on commercial real estate because companies do not need the kind of footprint that they had prior to COVID and will not need, most likely, that going forward. And so we've seen huge change, and it's the same with with London and these major cities around the world where commercial real estate values have had to adjust massively to this.
And if we look at residential real estate in the US, I understand that in the US, majority of people have fixed mortgages for a lot longer periods than they do in Europe and in other countries. But obviously, with people being able to spend a lot less money because they have a lot of less money in their savings and they're borrowing money on their credit cards, eventually you might see some of those defaults, but they might come a little bit later than what you might see in Europe when those rates are forced upon you quicker.
That's right. So you can get a 30-year fixed mortgage here. It's one of the most common, if not the most common mortgage for people to do. And so clearly, if you had gotten in a mortgage or you refinanced at any time before 2022, then you're sitting on a mortgage that is, very valuable to you at the moment because it has a very low interest rate, clearly in below market interest rate. And so that's what's really the crux of the problem, is that the vast majority of people are in that situation. So therefore they have no incentive to move, because to move means that you would now have to get a new mortgage, and therefore that would be a lot higher level and clearly would be unaffordable for the same type situation for a lot of people, given the same amount. That if your payments were twice or three times what they are today, many people wouldn't be able to do that trade. That means you're stuck in your current house unless you absolutely have to move. And then therefore people who are looking to buy are also stuck because there's very little incentive, if not no incentive, for sellers to sell, and therefore the inventory is really low. So that's really the only thing that's keeping prices high, is because there's no inventory. But the only way that becomes unstuck is if you start to make the financing option more attractive, which right now is prohibitive.
So when the rates do go down, we could see some of that come unstuck in the short term, especially, yeah?
No, absolutely. It will be a big phenomenon of adding liquidity into the market and see a lot more action for buyers and sellers alike. It's just the natural, I think, consequence of raising rates is that you tighten credit conditions, exactly what the Fed wanted to do. And when you tighten credit conditions, that's the ultimate impact that you have, is that for a lot of people, they're stuck. And the same with the holders of real estate, commercial real estate loans, that if you financed at a low level, you are fine until those loans have to be rolled over, which a lot of them are being rolled over now or in the next couple of years, where those properties will become unaffordable because the equity will be sucked out of them, the debt burden's too high, and therefore people will just literally give the keys back to the bank, so to speak, as they have been doing, and that's why the prices are plummeting.
Okay, at least the unemployment rates are still fairly low in the US, and that's a bit of a saving grace. I guess it's something to watch out for. If those increase significantly over time, that's probably when you'll start to get more defaults. All right, so I wanted to talk about another area that I know that you specialize in as well at GraniteShares, and that is the precious metals sector. And I wanted to talk a little bit first about gold. I know that you have your own ETF in gold. Obviously, it's gone up about 16 or 17% year to date so far. Has the performance of gold surprised you in 2024? And what do you think is driving the performance of gold this year?
I have to say that it has surprised me, because since I've been involved in gold, I saw gold break $1,000 for the first time way back before, or around about the time of the financial crisis, and then to break $2,000, and now to be at 2,400 plus the new sort of all-time highs, in an environment where we have the highest interest rates that we've had for a long time. This is something that is very unusual. And so it begs the obvious question, what else is going on? And I think that there's a couple of things worth mentioning. That number one, the strongest relationship that gold has is typically with the US dollar. And while the dollar has been strong, I think the signal clearly that interest rates are going to come down or inflation is moving down means that expectations for the dollar are getting weaker. And with that, that does help gold, and that is the strongest relationship that gold has over the long term. The thing, though, that has probably moved gold the most this year is just demand, and that's buying of gold from really two particular places. One, central banks. And so these are central banks around the world that are buying gold. Mostly what they have in common is they're central banks from countries that are exporting countries. And those exporting countries are accumulating large amounts of foreign exchange reserves as they sell their goods into the US market, etc. So typically they might be accruing large amounts of dollar reserves, and they want to diversify those reserves. And by doing so, they're electing to buy a lot of gold. So that's a trend that is not a new trend. That's been happening for many years, but seems to be continually very robust and seems to be accelerating. I think the main swing factor, though, that this year has to be about the Chinese retail consumer. And this is a story that perhaps, again, is a bit of a surprise to people that don't follow gold that much, but it's a direct consequence of what's happening in the Chinese economy. So Chinese consumers, Chinese investors, their sort of first thing they would do with any kind of wealth that had been built up was to buy property, buy real estate. I mean, that's no different to a lot of countries around the world. But as people might know, China's property market has been going through a major crisis. And a lot of Chinese investors that bought not only just one home, but were buying maybe second homes or third homes in order to invest money in the property sector have been badly affected by this. And so people have lost confidence in the real estate market and property more broadly. And therefore, again, when people lose confidence, what do? They go to something that they can trust. And one of the assets, I should also say, that is freely investable and freely tradable in China, because putting your money offshore and buying NVIDIA is not a possibility for the majority of people because of currency controls or capital controls. So buying gold outside of property is really like one of the only sort of choices people have for something that's freely available and freely investable. So a lot of demand for gold this year has come from those Chinese consumers who, again, have had a terrible experience, lost confidence in their property sector, and have resorted to buying gold in order to protect their wealth.
Yeah. And I guess they don't want to hold too much yuan in the country, and they're not able to get the money out of the country into other countries. I know that they were buying properties previously, I know, in Australia and Canada and other places, but that obviously has its shortfalls as well and has its cons.
That's right.
It does make a lot of sense because the real estate market has really suffered over the last couple of years in China, but it was in a massive bubble. So I used to live in China, and I remember many years ago, everybody was buying property just as an investment. Most of them weren't living in those properties, and eventually it catches up with you.
Yeah, and that was really part of the general trend of people who could and who wanted to getting money out of the country, whether they bought real estate or whether they bought stocks, any kind of asset just to get the money out of the country. So the Chinese government have clamped down on that massively. And so that's why you've seen, indeed, of real estate markets, which were really hot for particularly for Chinese customers, like some of the Canadian markets, have really cooled off because of that. And again, Chinese investors that were buying anything from US companies or European companies to stocks, any kind of assets, that's cooled down as that's clamped down. So there's been a lot of domestic interest in gold. The market forces have taken a hold of it, but clearly some of the stories that you read about were just crazy in terms of these ghost cities and the amount of debt that was being taken on by some of the largest builders, the Evergrandes and things of the world. Some crazy stories, and that will take a long time to really fully settle and work its way through the system.
Yeah. Okay. And do you think that anything of the move in gold is to do with some of the geopolitical tensions that are in place at the moment? So I'm thinking potentially about the Taiwan China disputes, as well as Israel and Palestine. Do you think that kind of is increasing the price in gold?
Yeah, it has. There's no doubt. I don't think it's as significant as the other factors I was talking about, but no doubt Russia, Ukraine, clearly that affected gold, that affected all commodities. And then you saw that premium, if you will, start to come out of the market longer that the war kind of ground on. And I think the same thing was a renewed amount of interest again in gold with Israel, Gaza. But again, some of the premiums come out of it a little bit from that. But it's still elevated in terms of geopolitical tensions. And like you said, China, Taiwan, or just more broadly, any kind of escalation that might happen always historically benefits gold. But I think my sort of take on the investment landscape again here in the US is for really for people to become motivated to buy gold significantly, there has to be a fear factor. And I don't see that from an investor perspective. There's enough fear right now, and that's not triggering the kind of big investment flows into gold. And you've seen that this year. So that final move whereby people really get motivated to do something, we don't have enough fear yet for that to happen.
Any ideas of the sort of triggers that it might take for people to have a lot of fear in the market and move towards gold?
Yeah, I think it's the same as always have been. Like I said, a big geopolitical event, but more likely and more credibly, another market crash, whereby, again, people are not so much worried about the return on their capital, they're worried about the preservation of their capital. And again, that motivates people more than anything else. A particular event, whether it's the next credit crisis or the next market crash, next recession, or a combination of all of them, that's really the catalyst that ultimately gets people defensive and gets people into gold. So at the moment, again, it's just not something that you can really see a clear reason for that to be the case now. But that's always been the kind of the prime catalyst for people getting into gold.
And as interest rates start to come down towards the end of this year and next year, I wonder if that will play a factor into the price of gold as well. If there's more money printing, for example, in the economy, whether people will start to move towards gold. Do you think that could be a small catalyst?
Yeah, I mean, again, I think that's always bubbling in the background. That debt to GDP ratios for most Western countries only go higher, not lower. And so countries are accumulating more and more debt. Obviously, just saw a Labour government getting in the UK, and we don't know exactly what that means yet. But if it means increasing the debt load, then debt to GDP ratio increases, and all things being equal, I think that's positive for gold, because the more debt that's accumulated, the more likely or the more there's a chance of something breaking, and or people saying, hey, look, I need to own gold here. I can't hold the country's currency, or I don't want as much exposure to the currency. So I think that is something that is only going to get bigger unless there's a radical change of policy right at the top, which I don't really see that happening anywhere at the moment.
Okay, and so how high do you think gold can go towards the end of the year? What's your forecast for gold?
I think that gold can make a new all-time high from here, 2,500 an ounce. That certainly doesn't seem unreasonable. Could it go over 3,000? Probably unlikely by the end of this year. But certainly I think that it can move up from here before the end of the year.
Okay, cool. And lastly, I thought we'd touch upon silver as well. Are you quite bullish on what's happening in silver? Obviously, silver's outperformed gold a little bit this year. Are you quite positive on the future prospects of silver?
I think you have to be in a world where gold is reaching all-time high. That's just simple. I know that some of these ratios and some of these relationships are not gospel. And clearly, there can be fundamental reasons for why the price of silver might underperform for a long period of time in an environment where gold prices are going up. However, I think that it's just one of these things that it's difficult to be really negative on silver in an environment where gold's reaching all-time highs. And so typically, the relationship, the correlation between gold and silver is very strong. It's the highest in the precious metals. And typically, in an environment where gold prices are rising, silver prices are rising as well, or will rise as well, albeit with a higher level of volatility. And again, the one thing that really can derail silver is slow down in economic activity, because the majority of silver demand comes from industry. But again, it's difficult to see where that's coming from. The Chinese situation was an obvious one, but it seems like that perhaps, I don't want to say that's behind us now, but at least that Chinese economy seems to be stabilizing. But again, with GDPs growing, certainly in major Western countries, it's difficult to see where that slowdown for silver immediately comes from. That seems like that we need more and more silver for all these green initiatives and broader industrial applications for silver. So it's difficult for me to make a real bear case for silver right now, especially with gold at these prices.
Yeah. And the Chinese are buying up a lot of silver as well, aren't they, for the industrial use, for the Belt and Road Initiative throughout the world. Okay. And I thought we'd end on something that I think you also have an ETF in platinum. And I thought we'd lump in platinum and palladium in together because I think they have a similar use case in the automotive industry. They haven't performed as well so far this year compared with silver and gold. Can you just explain a little bit about why they haven't performed well and what you think of their future prospects are?
So although they sometimes get lumped together, they're quite different metals. So they are both used in automotive applications, principally for catalytic converters that clean the emissions from your car, your either diesel-powered car or your gas or petrol-powered car. Palladium probably suffers from two fundamental factors. One was an oversupply in the market and a lack of demand from the traditional internal combustion engined vehicles. It's principally used for gas powered cars. And so combination of too much supply and slowing demand from that sector. Platinum had, or has, I should say, a much more interesting story in that there's been supply constraints because of what's going on in South Africa, everything from power crises, i.e. electricity supply to mines, where the majority of platinum, I should say, comes from South Africa, is mined from South Africa. So anything from electricity shortages to labor disputes and labor problems has meant issues with supply. And of course, the main application for platinum in the automotive industry is for diesel engines. And of course, the demand situation hasn't been great for diesel. I think the one bright spot, which hasn't really materialized as of yet, is that platinum has an application in hydrogen technologies. So for hydrogen, whether it be hydrogen-powered cars, hydrogen-powered vehicles, or even the production of green hydrogen itself, you need platinum for the catalyst. So that's a bright spot that potentially could be interesting for platinum, but hasn't materialized clearly as yet because hydrogen technology hasn't gone mainstream. But it's certainly something to keep an eye on for the future.
Yeah, something that investors can look at for the long term.
Yeah, exactly.
All right, Will, how can people find out a bit more about you and how can they read more about you and also about GraniteShares?
Yeah, in terms of myself, we've got the website, which is graniteshares.com. It's probably the best place to start and look up graniteshares.com. We have a good number of resources on there. And then myself, I'm available on most of the social platforms, but LinkedIn and Twitter at Will Rhind on Twitter. So follow us on Twitter, follow us on LinkedIn. We post regular updates on different things that are going on. And then ultimately, any of our ETF products, the one sort of potentially obvious for the majority of people hopefully listening, but it's always worth mentioning that you can't buy those directly from us. So they're listed on stock exchanges around the world, and you buy them through your brokerage app, whatever broker that you use, you buy them just like a stock. So whether you're in the UK, whether you're in the US, you can access the GraniteShares range of ETFs through your designated broker.
Okay, excellent. Glad to see that you're having a lot of success in your business. And I will provide the information below in the description on how people can reach you and find out more about GraniteShares. So I really enjoyed the conversation today. It's been really great to talk to you. Hope I can have you on again sometime in the future. And I think the listeners are going to get a lot from this conversation as well. So thank you a lot for your time and I look forward to catching up with you soon.
Absolutely. Great. Thanks for having me on. And great to be on the show. And yeah, would love to come back. Thanks, Steve. Much appreciated.